Have you ever felt like the economy has a mind of its own? One minute things are absolutely booming, and the next it feels like everything's grinding to a halt. Well, it turns out there's a rhythm to this madness, a pattern that affects everything from our jobs to our investments. So let's pull back the curtain and really understand the forces that are shaping our economic world.
So here's the big question. Are all these ups and downs just random? Is the economy just lurching from one chaotic event to the next? Or is there something a little more predictable happening right under the surface?
And the answer is no, it is not random at all. Economists have actually identified a recurring pattern of expansion and contraction that they call the business cycle. It's this sequence of events that gives us a framework for understanding why and how our economy shifts over time.
Now, this isn't some newfangled idea. Way back in 1946, economists Burns and Mitchell laid out this foundational definition. They saw it as this widespread wave of activity, moving from good times to bad times and then back again. The key phrase they used was recurrent but not periodic, which is just a fancy way of saying it happens again and again, just not on a perfect, predictable schedule.
So let's boil it down. The business cycle is really the natural ebb and flow of the economy. A great way to think about it is like the economy's pulse. It speeds up during expansions and it slows right down during contractions. And it affects pretty much every single industry.
Okay, so to really wrap our heads around this, we can break the whole cycle down into 4 distinct phases. Understanding these stages is kind of like having a map for the economic journey. It shows us where we've been, and it gives us clues about where we might be heading next.
And here they are. You've got recovery, then expansion, then slowdown, and finally contraction. Each phase flows right into the next in this predictable sequence, and that's what creates the continuous rhythm of the business cycle.
Now, this is where it gets really interesting, when you see how each phase impacts the job market. During a recovery, for instance, the layoffs stop, but companies are still hesitant to hire new people. Then, boom, you hit the expansion phase, and hiring really takes off. In a slowdown, hiring is still happening, but it gets a lot more sluggish. And finally, in a contraction, you see hiring freezes and eventually layoffs.
And look, this isn't just theory for a textbook. Knowing which phase we're in has massive real-world implications. If you're running a business, it helps you decide if now's the time to build that new factory. If you're an investor, it might change whether you're buying stocks or looking for safer bets like government bonds. It matters.
But hold on. There's another force at play here that can make these cycles even more extreme. And that force is credit. The availability of money, loans, doesn't just follow the business cycle, it can actually pour fuel on the fire.
This slide really highlights a key difference. The business cycle, that's all about tracking overall economic activity, usually with something called GDP, which is just the total value of everything a country makes. The credit cycle, on the other hand, is all about how easy or hard it is to get a loan. And here's the kicker. Credit cycles often last longer, and their swings can be way more dramatic.
So here's how it works. In an expansion, everyone's optimistic, so banks lend money freely. This easy credit then fuels even more spending and investment, which supercharges the boom. But when the economy turns, lenders get nervous. They tighten their belts, and this credit crunch can literally starve the economy of cash, turning what might have been a mild downturn into a really deep recession. The 2008 financial crisis was a perfect and brutal example of this in action.
So if these cycles are so important, how on earth do we know which phase we're in? Well, economists don't just guess. They have a whole dashboard of specific data points they look at, and these are called economic indicators.
First up, you have the leading indicators. The best way to think of these is like an economic forecast. They're the signals that tend to rise or fall before the rest of the economy does, giving us a little hint of what's just around the corner.
Next up are the coincident indicators. These are like a real-time snapshot of the economy's health. They move right in step with the business cycle, telling us what's happening pretty much right now.
And finally, we've got the lagging indicators. You can think of these as the rear-view mirror. They only change after the economy has already shifted direction, basically confirming that a peak or a trough has officially passed.
Okay, let's make this tangible with some real-world examples. Building permits, a classic leading indicator. Why? Well, you have to get a permit before you can start building a house or an office tower. It's a clear signal of future activity. Industrial production is coincident. It's a snapshot of what our factories are churning out right now. And the average time someone is unemployed, that's a lagging indicator. Think about it. Businesses often wait until they're absolutely sure a recovery is real before they start hiring again. So that number only gets better after the economy's already turned the corner. So when you put all these pieces together, the 4 phases of the cycle, the amplifying effect of credit, and all the signals from these different indicators, the economy starts to look less like a total mystery and more like a system you can actually begin to understand.
So here it is, your final takeaway toolkit. The economy moves in a 4-phase cycle. Credit can make the good times better and the bad times worse. And by watching that dashboard of indicators, we can get a pretty decent idea of where we are and maybe where we're going. It's not a crystal ball, for sure, but it is a powerful map for navigating the economic landscape.
And that leaves us with one final question for you. Based on everything you're seeing in the news today, thinking about hiring, about spending, about business confidence, what phase of the business cycle do you think we're in right now? It's a pretty interesting question to think about.